So guys, right now my portfolio is sitting at all-time highs, which on one hand is really exciting. It's cool to know that you're making money and building wealth. I mean, that's the whole point of all this, right? But on the other hand, that also means stocks are getting more expensive. And when that happens, there are fewer deep discounts to take advantage of, which is a big bummer. But fear not, my fellow investors, because I've still managed to find 3 stocks that look like pretty good buys as we step into September, and we're going to talk all about them. Real quick though, before we get to those, I want to hear from you. Leave me a comment below and let me know which discounted stocks you currently have your eye on. And also guys, if you want to keep track of how all of my stock picks in this series are performing, I put together a free public scoreboard where you can see everything in one place. This spreadsheet tracks how all of my stock picks have done since mentioning them in these videos. And if you want access to the spreadsheet, just click the link in the description of the video and you can get it sent straight to your email. So FactSet is basically the data backbone of the investment world. You can think of it like a giant data library and toolbox rolled into one, and it's built specifically for financial professionals. FactSet has mountains of financial data, everything from share prices and financials to earnings reports and transcripts that they license out and also package into their own software. Their partners include some of the biggest names in finance and tech. We're talking Amazon Web Services, Anthropic, BlackRock, Credit Suisse, and Equifax, just to name a few. To get access to all of this, FactSet's customers pay a subscription fee to get access to the platform and data. And the beauty of this business is that once they become customers and get used to using FactSet, it becomes pretty sticky. Their customers build their entire workflows around the platform, which makes it really hard to want to switch. And that recurring subscription model with the high switching cost gives FactSet a very stable and a very predictable revenue stream. Now, with that said, one of the big concerns with a company like FactSet is that AI will come in and just make the business irrelevant. But FactSet is actually leaning into artificial intelligence. They're not trying to fight against it. They've been building out data packages specifically designed to power AI tools. So the information is already organized, licensed, and ready to plug directly into other AI-powered platforms, which could make them even more valuable as AI use becomes more widespread. At any rate, looking at FactSet over here using Snapstock, which you can start using right now for all of your stock research and analysis, there is a link to Snapstock in the description of the video and in the pinned comment. You should definitely check it out. But here we can see the share price has taken quite the hit in the last month. It is down over 8%, so a very big drop for these guys, which is going to leave the stock down a whopping 19% so far in 2025. Another very big drop. And zooming out over the last year, the stock is still down 13.2%. So it's down all across the board. Still, despite this poor share price performance, FactSet looks to be a pretty high quality company. The Snap score is coming in at 7.5, and we're seeing some pretty solid scores from top to bottom. Growth's looking good, profitability's amazing, debt's pretty decent, dividends and buybacks are fantastic, and capital efficiency, which is going to be like their returns on assets, returns on invested capital, stuff like that, is pretty decent too. And scrolling down, taking a closer look at all of this stuff, starting here with the growth, we can see that from top to bottom, from revenue all the way down to free cash flow, FactSet has been a very solid grower. Everything here is just straight up and to the right, and everything looks to be growing at a pretty similar rate. Revenue's growing the fastest at 10.2% over the last 5 years. Earnings per share is coming in at about 9.5%, and free cash flow really is right there neck and neck with the earnings per share growth. So all in all, it looks pretty solid. And then if we scroll down looking at the debt situation, we're going to see our first red flag here according to Snapstock. And this feature is exactly what it sounds like, guys. So anytime there's any sort of red flag or potential warning with any of the companies you're looking at, it'll show something like this and explain a little bit of what's going on. So here with FactSet, we can see that the net debt has grown by an average rate of about 41% per year over the last 5 years. And really where all of that's coming from is this big jump between 2021 and 2022, which is a pretty undeniable jump in debt right there. A bit concerning, but they have been paying back that debt ever since issuing it. And still looking at the net debt to free cash flow, things look to be in pretty good shape. The net debt to free cash flow in the trailing 12 months is only 2.2. So that's quite a bit below where I'd like to see this number. For a company like this, I'm kind of looking at 5 or below for the net debt to free cash flow. That's kind of my threshold. So still in good shape there, and hopefully they'll continue to chip away at that debt and bring it back down. Now, if we scroll down looking at the dividend stats right here, the average yield is about 0.85% over the last 5 years, but right now it's coming in a bit above that. The dividend yield in the trailing 12 months is 1.07%. So even though the yield in itself is low, it is a bit above the 5-year average, and the dividend growth has been very consistent. Over the last 5 years, it's grown by about 8% on average, and over the last 10 years, it's even faster at just over 10%. But either way, the dividend growth is nice and it is consistent. consistent. Not to mention the dividend is very well covered. Looking at both the earnings payout ratio and the free cash flow payout ratio, it tends to hover at about 30% or below in the trailing 12 months. The earnings payout ratio is coming in just above 30%, and the free cash flow payout ratio is actually a bit lower at only 28%. So looking good in both departments. Overall, I think there's a lot to like about this company, both quantitatively and qualitatively, and I actually just added FactSet to my own watch list, so I will be keeping a closer eye on this one moving forward, and I'm excited to spend some more time with it. So in their own words, Idex is a corporation that has undoubtedly touched your life in some way, and that's not hyperbole. It's actually pretty accurate when you think about it. At its core, Idex is a diversified industrial company. They design and manufacture thousands of very niche and highly engineered parts that end up in industries like healthcare, safety, fire and rescue, agriculture, energy, and even food production. From the clamps that keep your car's airbags in place and ready to go in case of a crash, to the components inside DNA sequencing machines, and to the hurt jaws of life rescue tools that literally save lives, it's all Idex. These aren't flashy consumer products by any means, but they are mission critical components that make sure things work when they're supposed to, which is especially important in the case of emergencies. And speaking of emergencies, it seems like the share price is having quite an emergency itself. It is down over 10% just in the last 30 days. We can see it really jumped off a cliff right here at the end of July, which was earnings related, but they beat on both the top and bottom line and also grew their revenue by 7% year over year. So that actually looks pretty good to me. I'm surprised the share price didn't actually go up from that. But still, this drop is going to leave the share price down about 18% so far year to date. So that's even worse. And if we zoom out over the last 365 days, it is down 17%. So the share price really cannot catch a break. And looking at the snap score, this is coming in at 6.6, so about 1 point below the first company. But I still think these scores are looking pretty solid. Growth is going to be the weakest score, which is also one of the most heavily weighted sections of the overall snap score. So that's mostly what's going to be bringing the overall snap score down to where it's at. But I think everything else is looking good. Profitability 7.4, debt's about the same, dividends and buyback 6.6, capital efficiency just over 7. So the rest of the scores look pretty solid. But scrolling down, taking a look at the growth, which is the laggard, I gotta say, I think these charts all look pretty solid. The revenue's grown by about 8.6% over the last 5 years. The earnings per share growth has been pretty decent, 7.5%, although these last couple of years it has seen a bit of a pullback. But despite that, overall it's looking good. The general trend is up and to the right, and the same is true with the free cash flow per share, but the CAGR looks the weakest here. The 5-year free cash flow growth rate is only 4%. And I think this is the main thing bringing the growth score down, because the free cash flow is a bit heavier weighted than the earnings per share and the revenue growth. But still, taking all these things together, I think it looks pretty solid. And if we scroll down looking at the debt situation, this is also looking great. Looks like they saw a big jump in debt in 2024, which is where the first red flag is going to be. Once again, another very big increase in debt. But looking at the chart, it's really no surprise. 2020, they hardly had any net debt, and it's really shot up over these last few years. But still, despite the big jump, the net debt to free cash flow is still looking to be in good shape. It's only 2.2, which is not too dissimilar from what we saw with FactSet. So I think that's really good. And the interest coverage is also really good. And the last year was at 15. So overall, debt doesn't look to be an issue, not at least in my opinion. If we scroll down, getting into the good stuff, looking at the dividend stats, the dividend yield is quite a bit above the average, coming in at 1.6. The 5-year average is about 1.1. So that's pretty good to see. And the dividend growth rate is very nice as well. Very consistent dividend growth. They've grown it by almost 8% on average over the last 5 years, and a little bit higher over the last 10 years. And with that said, the dividend growth over these last few years looks to be picking up. In 2020, it dropped down to about 3%, but it's still good to see them growing the dividend in this year. That was a tough year. And since then, almost every single year, they have increased the rate of that dividend growth. And now it's kind of settled in the mid to high single digits, which is totally fine. And then scrolling down, looking at the payout ratios here, the dividend is very well covered. We do see a slight increase in the earnings payout ratio right here, going from about 30% in 2022 to about 45% in the trailing 12 months. So this is something you'll want to keep an eye on. This number right here is not anything to be alarmed about, but the general trend, if it continues, could be cause for concern. But right now, with the payout ratio still below 50%, I wouldn't worry about it too much. And we are seeing a little bit of a similar trend here with the free cash flow payout ratio. In 2023, it was at 30%. In the most recent year, or in the trailing 12 months, it was at 35%. So a slight jump, but but still nothing to be concerned about. I think this is looking great. So with all of that said, overall, Idex is really not the most exciting business, I would say, but that is okay. When it comes to investing, boring is actually better. And this one looks to be a very consistent grower, both in terms of the financials and in the dividend department. So across the board, I think it's one worth considering for sure. Now, our third stock of the day, guys, which is Accenture, is one of the biggest consulting firms in the world. So basically, companies hire Accenture to help them solve problems, improve their operations, and keep up with new technology. And that can mean anything from helping a bank digitize their operations, to helping a retailer automate its supply chain, or setting up cloud and AI systems for a Fortune 500 company. So basically, when a business needs expertise that it doesn't have internally, it can call up Accenture, who will come and help them figure out and solve whatever problems that they're having. Accenture basically acts as an extension of their clients' teams. And just like the first two companies, Accenture's share price has really suffered as of late. It's down 8.3% just in the last month, and year to date, it is down over 25%, almost 26%, and over the last year, it's down just over 26%. And it's crazy. If we look at the chart here, it looks like the share price peaked at almost $400 per share back on February 5th, and now, as we can see, it's sitting at about $255, so that's quite a big drop. And if we look at the Snap score, we're getting a pretty high quality company. Okay, coming in at 7.3 overall. Growth is exactly what we saw with the last company. Profitability looks to be a bit low as well, the lowest of the day, but everything else is top notch. Great debt score, great dividends and buybacks, and great capital efficiency as well. So let's scroll down and see what we're working with here. Getting into the growth category. Personally speaking, I think they deserve a higher score than a 5.2 out of 10. I mean, as we can see, everything is just straight up and to the right. Their revenue growth is very nice, double digits over the last 5 years. Earnings per share is really not too far behind that. And free cash flow per share is once again the laggard at 3.5% growth over the last 5 years. And it's this right here. We see the free cash flow per share growth really slowing down, and that's going to bring down the overall growth score, since once again, the free cash flow is the most heavily weighted when crunching that growth number. With that said, scrolling down, looking at the debt situation, it actually has a red flag over here looking at the net debt, but overall the net debt is negative, which means they have more cash on their balance sheet than they do debt. And the reason it's showing a red flag for this net debt is because in 2023, they had a net cash position of $5.9 billion, but in the most recent year, that really diminished, and the net cash position was only sitting at $884 million. So quite a difference here. But still, at least in my opinion, the important thing is that they have more cash than they do debt. As long as that's the case, or as long as the debt situation seems fine, which it totally does here. I don't think we're at risk of Accenture going bankrupt anytime soon. And as long as that's the case, that's fine by me. Now, with that said, looking at the dividend stats, this one's going to have the highest yield of the day at 2.1%, which is way higher than the 5-year average yield of only 1.3%. So getting a nice deal there, and the dividend growth rate is really good, guys. 13%. This is the highest that we've seen all day. And it looks like, if we look at this chart over here, the dividend growth rate has picked up over the years. For the last 5 years or so, 4 or 5 years, the dividend growth rate has actually increased. So that's always a good sign when you see that growth picking up. And if we look at the payout ratios, the dividend still looks to be very well covered. It looks like the earnings payout ratio went from about 35% in 2022 to about 47% in the trailing 12 months. So we do see an increase here, but still below 50%. That dividend is very well covered. And we do see an increasing trend here in the free cash flow payout ratio going all the way back to 2019, which is why there's this red flag right here. It's because this trend is increasing. But still, we see it go from 24% in 2019 up to 39% in 2024. So that is a decent jump, if I'm being honest. But this payout ratio is still below 40%. It's fine. It's not a big deal. Overall, I think Accenture is looking like a solid contender if you're in the market for another great dividend growth stock. And I think the same is true for all 3 of the companies that we've looked at today. With that said, though, these 3 are not the only ones. There are still a handful of other stocks that I think you should keep an eye on. The first of which, guys, is Badger Meter BMI. I talked about this one in last month's video, but it's down even more in the last month. It's down another 4% or so. And if we look at the year-to-date performance, Badger is down 11.6%. So a pretty decent drop for these guys. Anyway, next up is Mid-America Apartment Communities, a very solid REIT that focuses on rental real estate in the Sun Belt region. In the last month, MAA is down 5.8%, so a pretty decent drop. And year-to-date, the stock is down 4%, so definitely a good one to keep an eye on. Moving on, I also think Morningstar is one to watch. The stock is down 5.5% in the last month. month. And if we look at the year-to-date performance, it's seen a huge drop. It is down almost 21% so far in 2025. And moving on, I know a lot of you guys are buying this one right now. This is Novo Nordisk, NVO, who is down a lot in the last month. The stock is down almost 20%. In year to date, it has really sank. It is down about 34.5%. And it looks like we're getting a really high quality company, a very high snap score at just above 9. You don't find those too often. Anyway, guys, moving on to the next one, keep an eye on Otis. This is a good one to watch. The stock is down 2% just in the last month, so not a super crazy drop there. But year to date, it is down 5%. So I think it's a good one to keep an eye on. Moving on, this next one is Texas Pacific Land Corporation, TPL. I know a lot of you guys out there are buying this one as well. The stock has seen a nice pullback in the last month. It's down 7.6%, and year to date, it has really sank. It is down over 23%, so definitely keep an eye on this one. And then moving on, I talked about this stock in last month's video. This is WD-40, very interesting company. It's actually up in the last month. It's up almost 5%, so it has seen a little bit of a rebound, but still year to date, the stock is down 7%. So I think it's worth considering still. Now, in addition to all of those stocks that we just looked at in this next video right over here, I'm actually telling you about 3 more stocks that look like good buys as well. These are all sitting right there at their 52-week lows, so they are down in the dumps and looking like good buys. So click right over here to check those out, and I'll see you in the next one.